you so much for coming, Mr. Lamensdorf. Am I saying it right?
Sure, Brad is fine.
Brad, okay. Um, you cover U.S. equities, economy, global equities. You know everything. So I want to start with the FOMC meeting. Is
Right.
that okay?
Sure.
All right, we had the meeting, and that was not a surprise. Was it a surprise to
No,
you?
I don't think it was a surprise.
But down on the road, what should we expect? Are they going to finish by September, as some say, or are we stuck with all the negative weather and the bad news coming from the emerging market and affecting America, the American economy?
I actually sit in the second thing that you had mentioned, which is I think the emerging markets is a huge problem. The Fed is doing what they need to do. They're starting to taper underneath a more strong economy. But the problem really is that the markets are way, way ahead of themselves, and we need a very large correction, and there's nothing the Fed's going to be able to do to correct that.
Well, how come do we see the reds today? You're talking about the correction, by the way. Lots of economic data came and went. Yesterday we had the GDP. Were you happy, by the way, with the GDP results?
I think the GDP is looking in a rearview mirror. I think at this point we've really milked as much of this QE as we can. And I really think that companies, their top line, their earnings growth has been horrendous. And we're trading at areas that we haven't seen since 2000 and 2007. Like I said, I think that we're down coming into the summer.
What do you recommend? I have your report as well, and it was an amazing, exciting report. I liked it, interesting too. But to your clients, to yourself, and to us, what would you recommend to focus on in terms of geography? Because some say, oh, you know, the emerging market, that's no bad news because everyone is coming to the safe haven of the U.S. bonds.
So I basically think that the bear market that started in the emerging economies will start bleeding into the G7 type indexes. And I think we'll see a lot more of that pain this year, obviously more so in the emerging markets. What am I recommending and telling people to do? Sell calls against your portfolio. I run a short-only ETF under the symbol of HDGE. It's a wonderful way to hedge or go to cash.
And you told me, yes, emerging markets news is at the beginning of our conversation. You said that it is bad. Is it short term or is it the beginning of many negative macro events that's going to come?
I actually think the emerging markets are going to get a lot worse from here. One of the things that they're very dependent upon is oil and oil prices. The shale revolution is going on, and we're actually pretty bearish on oil prices, which should hurt the emerging market communities a little more so.
You're bearish on the oil?
Yes, I am.
And in terms of emerging markets, all the countries, which are the ones that you think concern you the most?
Frankly, it's been Latin America. It's a pretty big surprise, but the price action of their markets has been more concerning to me than any other market in the world.
Ah, interesting.
Yeah.
Latin America.
Yeah.
And because of, is Argentina leading it because of what happened in the...
I think a lot of it has to do with they're very resource-based, and with China slowing down, it's just hitting them even that much harder.
So it's interesting that you're not worried that much about China, but more in Latin America. How about Turkey?
Turkey is very politically driven right now, so I don't know if I necessarily have an opinion there.
And okay, so I started with the Fed, and I want to continue with Fed again. How do you like the handing the flag to Yellen? It's a new era. Do you think she likes to do more? She said.
Right.
So I know Bernanke left the whole $10 billion deduction from the tapering to her, but is this going to continue? And we have Stanley Fischer. How do you like the new team?
I think it's the same as the old team. I don't think we can expect a lot different. And frankly, they're going to be trying to push on the string that much more and more. If we do get into a very big equity correction like I think we will, I think you will see that the Fed reverses course and they stop their tapering.
And I don't know if you do have any outlook, any projections in terms of the U.S. economy, GDPs, and also the non-farm payrolls. Because in their FOMC text, the text was basically the same. There were very little changes, but they said the labor market came mixed because of the results. How do you expect, how did you view that? How do
You
you
know,
comment that?
my personal opinion is that these labor statistics have been so manipulated that I'm not even sure if they really mean anything to me
Really?
anymore.
Tell me
The
more about it.
participation index is gotten creamed over the last 5 or 10 years. You're judging a smaller and smaller portion of the real people that are working. And I just find it, it's kind of like the CPI index. They keep telling us there's no inflation, but we all know that our health care bills are jumping 40, 50%. The CPI index is 10, 15, 20% of health care. So mathematically, tell me how the CPI could not jump mathematically if our health care costs are all jumping 30, 40, 50%. Like it's mathematically impossible, right?
Good point. And why do you think they're manipulated? Who manipulates them?
I think the governments are manipulating the CPI indexes. They're replacing steak for hamburger meat when steak gets too high, and it's constant. So I think there is underlying inflation, and I think the markets and interest rates are way behind where they need to be.
And are we going to reach 6.5% unemployment and 2.2% inflation to or higher?
We could if there's enough participation people that drop out.
I want to go back to your manipulation thesis. Durable good orders sank, right? We were expecting 1.8% increase, but it came minus 4.3. And it's a big component of the GDP. And I was expecting, oh, maybe GDP is not going to come 3.2, maybe
Right.
lower. And then they said, oh, it's because of the Commerce Department said it's because of the big ticket items like Boeing and other commercial aircraft orders. However, I know Boeing ordered 319 in December and only 110 in November. Why was that, do you think?
Yeah,
Different.
I'm not a big, I don't really tear apart these numbers like a chief economist may.
But because you said manipulation, so I thought
Well,
maybe,
I think specifically the CPI index
especially
specifically
CPI.
has been very, very, I mean, it's very comical. We're having this big a minimum wage discussion, and CPI is definitely a discussion when it comes to minimum wage, but yet minimum wage is one of the only areas of our entire society that's not indexed. Congress has to raise the minimum wage. It's kind of a bit comical, you know.
I like that. Okay, and I want to talk about your report right now. It starts with Buckle Up for 2014. I like the title.
It's good. It's going to be a rougher year this year. If anybody would like to get this newsletter, they can email me at brad@lmtr.com.
Why is it going to be a rough year?
Well, because we came out of last year with such high expectations. You had all the sentiment gauges at the upper 5 percentile of where they traditionally have been, which means expectations are very, very high. You had margin debt at an all-time high, over 2000 and 2007. The market capitalization of the entire marketplace relative to the GDP was higher than it was in 07, only to be rivaled by 2000. And I review over and over things within my letter that are gravitating to a very overbought market at this time.
I like that. And you said going ahead, we don't also have so many positive news, but how about the debt ceiling? February 7th is the deadline, I believe.
And again, I just think it's a non-event. It's something the news is going to pick up. But for me, all-time margin debt and stocks that are deteriorating. You have AT&T, Philip Morris. You got a lot of big companies hitting 9 and 10-month lows with the market literally just off of its all-time high. So I kind of refer that just to like peeling a banana, if you will. The banana stays really nice when it's in the peel or the indexes, but the more stocks or the more strands you pull away from that banana peel, the banana is going to fall right out of the peel. And the indexes are working in a similar fashion. Stocks are slowly underperforming. IBM's been underperforming, a name we've been short all year. And you're peeling the big companies away from the indexes, and eventually you're going to be getting some volatility down like you're starting to see now.
True. I'm glad you mentioned IBM, and also Apple had disappointing sales, iPhone sales. In general, 65% of the S&P 500 companies, I think, met analyst expectations. How did you like, and that's my last question, how did you like the last quarter's results? Were they disappointing or satisfying to
I
you?
thought they were very disappointing. Revenue growth has been disappointing all year, and now you're starting to get earnings growth disappointing. It's just not a great environment.
And anything else, that last 10 seconds that you like to add?
I think that's it.
Thank you so much for coming. We have to have you here again. Evet, sohbetimiz burada sona erdi. Sesler karşınızda İstanbul'da Hande.